Hello and welcome to UK Property Accountants. My name is Chirag, an analyst here at UKPA. Today we're taking a look at capital allowance and the different types of capital allowances for property businesses in the UK. Joining us today we have Prasun Shrestha, a senior associate in the tax team at our firm. Welcome, Prasun.
Thank you, Chirag. Thank you for having me.
So, what exactly is capital allowance?
When there is a significant capital expenditure that an organization makes, it does not make sense that 100% of that expenditure is claimed as a tax deduction in an accounting period. So when there is such significant capital expenditure incurred, these expenditures are basically bifurcated based on the number of years in which the asset has a potential benefit to the organization, and that is a capital allowance.
Okay, so would I be right in assuming capital allowance to be something like a relief?
Capital allowance can be said as a kind of relief because, again, it depends upon the kind of asset that you're acquiring. So it varies the kind of benefit that the asset is acquired and the percentage of benefit that such asset comes with. So yeah, it is a kind of relief that is available to an organization.
Okay, and how does capital allowance relief work?
For capital allowance, when there is a taxable trading profit in an organization, or taxable profit, let's say, after computation of all the sales and deduction of all those eligible expenses, whatever the residue is, again, that is reduced by the potential eligible capital allowance. And anything that is residue after deduction of capital allowance, that would be a net profit, which is then corporate tax is computed on that next net profit.
So, Prasun, what exactly are the different types of capital allowances?
The types of capital allowances are annual investment allowance, written down allowance, 100% first year allowance, 50% first year allowance, structural and building allowance, and full expensing.
You mentioned different types of capital allowances. Could you please briefly explain all of them?
So the first capital allowance is annual investment allowance, where 100% of the capital expenditure that you have incurred is allowed as a taxable deduction. So this is in contrast to what we have discussed earlier, the foundation of which was the 100% cannot be claimed as an expenses. So this is one of the exception to that. The another exception being 100% first year allowance. So similar to annual investment allowance, you can claim 100% of the capital expenditure that you have carried out on a certain specific asset can be claimed as a tax deduction. The main difference between annual investment and 100% first year allowance is annual investment allowance is applicable on second hand plants and machinery, which is not applicable in 100% first year allowance.
When it comes to annual investment allowance and 100% first year allowance, are there any other differences between the two?
Another difference, significant one, being that the limit is restricted in annual investment allowance, where it is restricted to £1 million. So whenever you incur any expenditure of £1.2 million, then annual investment allowance would be restricted to 1 million, which is not the case in 100% first year allowance, where you would be able to claim 1.2 million as a whole as a capital allowance. Continuing with the exception to the segregation of capital expenditure, another one being full expensing, where like annual investment allowance and 100% first year allowance, you would be able to claim 100% of the expenditure incurred on plant and machinery that is acquired from 1st April 2023 to 31st of March 2026. So this was brought in Spring Budget 2023.
Could you please elaborate on the other different types of capital allowances that are there?
Yeah, sure, Chirag. The other type of capital allowance is structure and building allowance. So as the name suggests, structure and building allowance is applicable on a construction of a commercial property. Under structure and building allowance, these construction of the commercial property is allowed a capital allowance of 3% for 33 years and 4 months. Another type of capital allowance is writing down allowance. Under writing down allowance, any of the asset which does not fall under annual investment allowance, first year allowance are generally covered under writing down allowance. Writing down allowance is again subdivided into main rate pool asset and special rate pool asset. Any asset which falls under main rate pool, it's 18% of writing down value, and under special rate pool it is 6%. And finally, the last capital allowance is 50% 50% first year allowance. Under 50% first year allowance, plant and machinery, which was acquired from 1st April 2021 to 31st of March 2023, was eligible for 50% of the allowance, and the remaining 50% would be covered under writing down allowance. And recently, from the changes that was brought in 2023 spring budget, it has been extended to 31st of March 2026.
Okay. And capital allowance is charged on assets, right? What would happen if I sold an asset on which capital allowance has already been claimed on?
When there is a sale of asset where capital allowance has been claimed, there could potentially be a balancing charge applicable. So balancing charge generally arises in the situation where the sale consideration is more than the value of the asset after considering the capital allowance. So let's say an asset where there was 100% capital allowance claim, like in annual investment allowance or 100% first year allowance, if that has already been claimed and if that asset is sold, anything, the sale consideration basically would be added to a taxable profit and corporation tax would be charged on that. So basically, if the value of the asset is above, if the sale price is above the value of the asset after considering capital allowance, then the difference amount would be chargeable to balancing charge.
With all the different types of capital allowances that you mentioned, how necessary do you think it is for a business or an individual to seek professional advice?
From a capital allowance point of view, it is important that a business owner or someone sole proprietor understand in precision that what kind of asset that they are acquiring and what kind of capital allowance that particular asset is eligible for. So it is important from a definition point of view as well, whether their asset is eligible for capital allowance or not, and also from a type of classification point of view, which class of capital allowance the specific asset is eligible for. Also, there could potentially be a tax planning that we can structure it around, where same asset can have a different capital allowance applicable, but from that point of view, structuring it around could be a more tax saving and tax beneficial for the business owner and a sole proprietor. And hence, it is important for business owner basically to understand the nitty-gritty of capital allowance.
Thank you for joining us today, Prasun. You truly make the complicated stuff very easy to understand. Capital allowances may seem easy to understand at first, but you may be missing out on some big savings. If you are looking for professional advice and want to know how you can save big money on your business, please feel free to book a free 15-minute discovery call with one of our experts. We will then ascertain your situation and let you know of the services that best suit your needs. Thank you and have a great day.